Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
Do you want to make your money work for you but find investment intimidating? Do you want to build towards a better future? With ATRAM Group's funds, you can invest according to your interests and values. Investing is now made easier and affordable. Step into your future self, invest to reach your goals and aspirations. Matching your risk appetite and investment horizon has never been this easy. Let us help you maximize your earning potential by writing the growth story of the Philippine economy and opening your doors to the international trends in the global markets. Let us prepare you for a better financial future. At ATRAM, we're making lives better through investing.
Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
The ATRAM Alpha Opportunity Fund Incorporated has one mission: to look for the winners of tomorrow. The fund actively finds the fastest growing Philippine companies with high quality management and sound business strategies. This growth has often translated to higher stock prices. The fund has a proven track record of selecting companies outside the Philippine Stock Exchange Index that were eventually included in major indices, while most funds in the market stay within the Philippines' top 30 companies. This has led the fund to consistently outperform the market in the long term. Furthermore, the fund invests in long-term drivers of growth that could provide significant gains for investors, such as technological advancement, tourism, infrastructure, and sustainability. Invest in the potential of the best growth stories the Philippines has to offer. Invest in the ATRAM Alpha Opportunity Fund Incorporated. For more information, visit www.atram.com.ph.
Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
What is a bond fund? Why invest in a bond fund instead of directly investing in bonds of actual companies? Corporate bonds are borrowings of companies to help finance their operations. In general, bonds are interest-bearing investments. You earn interest when you buy this particular investment. Think of a single corporate bond like a plant. It grows over time and blooms. Meanwhile, a corporate bond fund is more like a garden. A garden is more satisfying than a single plant. It contains different types of plants and flowers that are carefully picked and monitored by gardeners. They are studied every day to ensure that they will grow and bear fruit. The ATRAM Corporate Bond Fund is designed similarly. Recommended to investors with a moderate risk appetite, the fund provides you returns like that of a corporate bond but invested into multiple corporate bonds, providing you more safety in case one of the multiple companies are unable to pay. Diversification is ensured to make the fund more efficient and stronger than owning a single bond. The fund pays regular annual dividends, providing you with a small stream of income. Unlike a corporate bond, the fund provides you liquidity without sacrificing the price. And lastly, the fund is actively managed and constantly studied to minimize the risk of the fund losing money. Invest in corporate stability. Invest in the ATRAM Corporate Bond Fund. For more information, visit www.atram.com.ph.
Good afternoon, everyone. I'm Stan from the ATRAM Digital Channels team. And I'm delighted to welcome you all to today's Market Outlook covering the first quarter of 2024. And it's been a remarkable journey since our Market Outlook last year, during a time when uncertainties loomed large and markets were preparing for a widely anticipated recession. Shades of the pandemic continue to impact economic data, leading to significant shifts in the global investment landscape. Now, what we see is investors have faced challenges of navigating through conflicting macroeconomic signals and the market narrative that has been constantly changing. But despite these challenges, many economies have displayed remarkable resilience in 2023, even in the face of aggressive rate hikes and tightening liquidity. And this resilience has given rise to optimism about a potential soft landing. However, as we approach 2024, uncertainties persist. And as we step into the new year, we, ATRAM, are here to provide insights into the outlook for the first quarter, aiming to assist you in making informed investment decisions. But dear audience, before we formally begin, we're letting you know that this webinar will be recorded and posted in all our social media platforms, so you can refer to it whenever you need to. And whether you're a beginner in the world of finance or investing, if you want to stay up to date with the latest investment news and strategies, we've got you covered. Our YouTube channel, ATRAM Studio, has a collection of videos that features everything you need to know about finance, investments, our past webinars, and even ATRAM itself. So make sure you subscribe to our official YouTube channel and hit the notification bell to receive alerts on all your devices whenever we upload new videos. You can also find these on our website at atram.com.ph for more comprehensive information on the market, finance, investments, and all the funds we provide. Also, all of these can be found on our social media pages, and you can find these by scanning the QR code flashed on your screens. Again, we want to make this webinar as engaging as possible, so don't forget, we want to encourage you to participate actively. Any pressing concerns or questions related to today's topic, even before or after the webinar, please feel free to share them through the Q&A tab located below your screens. And every question you submit serves as a raffle entry, providing you with an opportunity to win exclusive ATRAM merchandise. So, the lucky winners will be announced at the end of the webinar, so be sure to stay with us until the very end. All right, is everyone ready? This afternoon, we are very privileged to be joined by an expert with over 14 years of experience in investment management and a scientist by training, earning a master's degree in physics at the University of the Philippines in 2007. Her interest in complex systems led her to seek a career in finance. Prior to the onslaught of the 2008 global financial crisis, she got her foot in the industry as an analyst and a market risk manager for the trust department of one of the top local universal banks in the country. And at present, she serves as ATRAM's Chief Investment Officer and Chairperson of the firm's investment committee. She's responsible for overseeing all the investment portfolio related activities of the firm, including formulation and implementation of strategic and tactical asset allocation decisions, fund and security selection calls, and even market risk management for ATRAM's discretionary managed accounts across equity, fixed income, and multi-asset strategies. Now, she's also a CFA charter holder and a member of the Board of Trustees for the CFA Society in the Philippines from 2017 to 2019, and a member of the Fund Managers Association of the Philippines. Now, dear audience, let's please give a warm welcome to Ms. Sandra Araullo.
Good afternoon, everyone. Thank you, Stan, for the introduction. And without further ado, I'd like to jump in to our market outlook for to kick off the year, no? And as always, we would take stock to start about how the past year has been. And on this chart, you'll see how the four broad asset classes have performed in the last year. So MSCI ACWI there is representative of global equities, while the global bond index is global bonds in dollar terms, no? Meanwhile, PSEI is in peso, and the PH bond index there is the government securities market. And it's been quite a bumpy ride for equities, particularly the global equity space. It's 20% returns last year, practically all happened in the last quarter. Contrast that with Philippine bond index, for example, which returned at 8.3% for the full year. It got there in the first half of the year, and would have been very sensitive to timing. If you had come in at, say, June or July, maybe returns would have been a more tepid 4%. The big disappointment is Philippine equities, practically flat for the year, despite the very favorable earnings results that the companies were able to deliver. And this has to do a lot with what's going on outside of or more of drivers that are global in nature. So You have what's going on in the US in particular, Fed tightening, monetary policy elsewhere. So those are the drivers. Of course, there were also the geopolitical risks that took place last year, no, ongoing Ukraine-Russia war, the conflict in the Middle East, and such, causing some volatility across risk markets. So maybe again, just going back and looking at recent history, in the next slide, you'll see that at the beginning of the year, we were a bit cautious around around the US markets, US equity markets. And this is because in January of 2023, we had seen US unemployment hit a 53-year low at around 3.4%. And based on the last 50 years, and more actually, US economic data shows that recessions are often preceded by these kinds of cyclical lows in the unemployment rate. At the same time, we felt that the farther away with every bear market rally, which we saw in the beginning of 2023, the markets were moving further away from pricing a recession and the possible earnings downgrades ahead. And as the Fed continues to as the Fed continues to tighten policy, the risk of over tightening is also what may cause this recession that we were concerned about. So from the beginning of the year, it was recession concerns. By the time we get to the middle of the year, it became a soft landing narrative. And on the next slide, that had been the case because as the Fed was successfully able to bring down US inflation from 9.1% to around 3.4 as of the last data print, it was tightening policy, yet US unemployment remained the jobs market remained hugely resilient. So on the left chart, you'll see the blue line representing US unemployment. And despite the higher interest rates, which drove US inflation to closer to the Fed's target of 2%, it didn't cause the economy to tip over, so to speak. So there was a durability of the overall economy as proven by this resilient job market. And far from what we were afraid of, that the US may go into recession, it actually even grew at a 4.9% annual pace in the third quarter of 2023. So this is really on the back of the consumer and business investment. So again, it wasn't just us who got that, who missed the mark there. Again, we were going by history of labor data and recessions and policy positioning that led us to be a little bit more cautious in the beginning of the year. And as we got the data, it showed a resilient economy nonetheless. So that's where in the third quarter of 2023, there was a risk rally that took place as the markets were more and more convinced that the Fed was done raising rates in July. And you'll see it on the next slide. So everybody now believes a soft landing, and sentiment and positioning is quite bullish. So on the left-hand chart is where earnings growth and real GDP growth is coming in. The expectations are for the rest of 2024 for earnings to remain robust. And these are forecasts by analysts. On the right-hand side, you'll see positioning data where we're hitting a very high optimism range for US equity sentiment, and also positioning of bulls minus bears. It's also in positive territory. So again, today everybody's quite bullish, and the soft landing narrative is what's driving markets to generate quite positive returns this early in the year, or at least continue the rally in the third quarter. In the next slide, why is that, no? Kasi very critical yung pivot or where the Fed moves from tightening to easing. And today we have a Fed that is on hold with policy, meaning the last time they raised rates was in July 2023. And historically, again, this is you'll see here how US 10-year Treasury bonds and the S&P 500 performed over those recent or over history, when the Fed moved from a tightening mode to easing policy rates. And easily for equity markets, it's a little bit more dispersed. There was a period in 1999 to 2000 where it actually generated negative returns, but on balance, it ranges anywhere from call it, you can see here, about 25% to even close to 50-60% in terms of the next 2 years of how the S&P 500 performed. On the bond side, it's a less dispersed historical performance, and over a 2-year period, 15 to 20% returns were what have been observed. So the red line on both charts show where we are at today from the last Fed hike in July. So actually, this would have been updated at the end of the third quarter. It would be that red line would be in more positive territory as we speak today. On the next chart, let's now move on to the local perspective. So similar story where Philippine inflation has or disinflation has pretty much been established from 8.1 to 3.9, and it continues to ease, reflecting successful efforts by the BSP to stabilize the consumer prices. Meanwhile, the annual GDP print even exceeded expectations in the third quarter. So came in at 5.9, which a lot of market participants perceive as signaling robust growth. Although that said, it did come in higher than expected. We saw domestic demand weakening, and it was really more of lower energy and commodity prices that were supporting the GDP number via contraction in the net trade deficit. No? So going into this year, that should normalize, and kind of or the effect of lower energy or commodity prices would be less felt, and the weakening domestic demand might play out more, and so this robust growth perspective can be challenged. So what we're seeing is that while we're pretty much back to normal, so to speak, from a economic activity standpoint, the economic scarring from the lockdowns of the pandemic are still now being felt via the investments component. So that is yet to come online, and we really need that to sustain robust growth for the Philippine economy. So that said, on the next slide, I just have the 6 macroeconomic views that we anchor our strategies on for the year. And we like to start with the global backdrop, the regional, and what's happening on the ground. And our base case assumption is that today there is a low probability of a technical US recession, and what we mean by that is a slowdown in growth. If anything, or a contraction in growth, not a slowdown. The slowdown is likely to happen, coming down to a low single digit or even flat in 2024. But it is still going to be consistent with a soft landing narrative. The catalyst for this likelihood or probability of a recession increasing would be if the Federal Reserve maintains rates at the current level of 5.5% beyond the first quarter of 2024. So we're watching that carefully. So that kind of captures the second point, where we assume that the Fed will maintain high rates into the first half of the year, but just to continue managing core inflation, which is assumed to be still stubborn for the first quarter of 2024. So it's a very tight balancing act by the Fed, and you'll see on the image that I just used here red, yellow, green, as indications of how positive or negative or maybe a little bit neutral. So it's still working, but it can change depending on developments later on. At the regional level, we are looking out for the impact of El Nino that is expected. This will affect productivity of agriculture, and therefore it threatens a flare up again of inflation. So that's something to watch out for. I color coded this red because it's quite important and it's critical. Also, what's happening in China, where they're managing their economic slowdown, it might introduce currency volatility if they draw down on their dollar reserves to maintain their managed currency, the RMB peg. Now, moving to the local space, we think that consumption is going to remain weak as savings rates rise. So post-pandemic revenge spending is pretty much done. Consumers are going to be mindful now of building up again their savings. And because of the high inflation from last year, its effects are still going to linger, and it will affect consumer behavior. The next point is that we think that private consumption demand will remain low, so particularly replacement of inventory and hard equipment. Replacement demand will kind of be subdued because of high interest rates. And again, inflation is still, while it's coming down, the effects from last year are still pretty much being felt. And it's really public investment that will have to carry the load there. The good news is after underspending in the second quarter of last year, the national government has shown in the third quarter a recovery in their ability to disburse and spend approved budgets, and that's helping stimulate economic growth for the country. Alongside that, we expect the national government to issue more debt to fund government spending, and also to service higher debt. For the needs of higher debt servicing. The BSP is also going to likely be watching the Fed closely for its signals to manage the imported inflation, if that's still a concern, and the local currency. So on the next slide, this is also another thing to watch out for. On the left-hand chart, you see where the Fed funds rate is, and the green line. And the markets or investors now are pricing in a very dovish 2024, which is reflective of double cuts from the Fed versus what they are actually guiding for. So again, it's kind of at this point, maybe for the next month or so, you'll see a bit of a pullback and adjustment of what's being priced in right now. Again, you have stretched valuations both on the bond and equity side, and it's to be expected to see some pullbacks here and there. On the on the right hand chart, is just an extension of this forward looking projection or what the market is pricing in. So from 3 months ago, the market was expecting the Fed to end the year at around 4.9% from a policy rate standpoint. But over the last, at present, it's the line or from yellow to orange to blue. You're showing there an aggressive adjustment of expectations of where the terminal rate will be for 2024. So again, it's really just where the market is today in terms of what expectations they're pricing, and it's a little bit there is an inconsistency with what the Fed is saying. Next slide is where our own GS market is at. So we do see really high potential for outsized returns from the Philippine bond market, in particular because of how inflation is not a big threat anymore. It's still something we're still watching it, especially in light of El Nino in the first quarter or first half of the year. But again, because the trend is for CPI to come into the 2 to 4% range. So actually, the expectation is on the first week of February to see it at 2.5%. Then we think that the yield curve is likely to steepen, or the lower end of the shorter end of the curve, or shorter tenor bonds will likely reflect dovishness of the BSP because of the where inflation data will be coming in. That said, there is on the supply side, on the national or on the debt side, there is a big maturity in March, which the BTR, or the Bureau of Treasury, will need to go to the market for to refinance, and that huge supply of debt might cause the long end of the curve or the longer tenured bonds to fetch higher rates from the market. So we might see here a steepening. So from today we're at the blue curve, we might revert to the yellow line from a shape of the curve standpoint. But again, it's dependent on a lot of things that haven't happened yet. By the second quarter of the year, actually, we expect from this so-called bull steepening, and also it's steepening because the bonds on the short end are moving lower, while rates on the short end are moving lower, while rates on the long end are moving higher. So it's there's the relationship between bond prices and yield is inverse, and when rates move low, prices move up, and vice versa. By the second quarter of the year, we think that we'll see some bull flattening this time, which means that the long end of the curve can adjust lower, and that's really where outsized returns are going to come from. In a nutshell, simplistically, because the BSP is more likely than not to ease policy rates moving forward, then again, as rates move lower and as inflation expectations also adjust lower, the potential for bond prices to move up is more likely than not. All right, so on the next slide, I just want to show here comparison between the government bonds, the PSEI earnings yield, and cash. So from a yield standpoint, the observation was because of how policy rates adjusted throughout 2020, I mean from mid 2022 until last year, no? So that's the yellow line, that's your cash time deposit return. The its it its yields, real yields were actually are very attractive. But as we move into 2024, bond yields are moving lower. And like what I said earlier, when bond yields are moving lower, prices of bonds move higher. So there is that term premium that investors are getting paid for now holding bonds. The next step is looking at the equity risk premium, or the earnings yield of list or of PSEI components. And that earnings yield has also widened significantly. So back in the beginning of the year, it really didn't make sense much. It didn't make much sense to hold equities from a risk return standpoint, and it actually played out. If you held Philippine equities last year, returns would have been disappointing, despite the fundamental reasons why Philippine equities are attractive. And so now, because of all of these moving parts, the equity risk premium is coming back to a healthy clip. So there is, and then you are getting paid for holding equity risk. So that kind of gives us a balanced outlook for the rest of the year. On the next slide is maybe just to expound on our view for Philippine equities. From a fair value standpoint, based on fundamentals, we see 7.4 as where it's at. Although as we hit 6.8, that will be a technical resistance level. Just let me check where it is today. Okay, so we're seeing a bit of pullback this today, or the last 3 days, the market would have lost a cumulative 1.2%, and we actually closed at 6.5. So we're kind of seeing that first hurdle at around the 6.5 to 6.8 level. That said, we do think the risk reward profile is quite attractive, with earnings growth still at 11% for the full year. And we think this will likely be led by property firms, holding firms, and the consumer names. Valuations are really attractive at 12.4 times PE. In the last 10 years, at the height, it's at 22, 23 times PE. On average, around 15 times PE. So it's from a 10-year historical basis, it's really cheap. Although again, there may be reasons why that's the case, and it has to do more with outside factors than the fundamental reasons for the market. Next slide, please. So that said, and while the beginning of the year is proving to be quite promising, so from the end of the third quarter, we've seen a Santa Claus rally. We've seen it persist in the first few weeks of the year. There are a lot of headline risks for the whole year. So there are the known risks and there are the unknown risks. And so the point here is, we're back in the third quarter. For those of you who were able to tune into the webinar, we were quite bullish or pushing for Philippine equities, and that kind of played out. Now that we're well into that rally, we're now looking for or are more cognizant that the markets will eventually start looking, or something will flare up, some headline risk will flare up, and it can easily cause a volatility event for the market. So again, while it's been good for the first few weeks of the year, there are current headline risks are plentiful, especially around geopolitical risk, and of course the macro risk that that a well-balanced portfolio should be able to weather. All right. On the next slide is maybe just a summary slide of our asset allocation views. We are the most constructive on Philippine fixed income from a risk-reward standpoint. Philippine equities, in the meantime, it's still looking attractive just because we've lagged other markets throughout 2023. And if this soft landing narrative or Goldilocks narrative persists for the US, then we would see foreign flows come back to emerging markets, to undervalued emerging markets such as the Philippines, and that might and we've seen it already actually. So it's a matter of how much momentum can build up, and again, it's a function of the data that will come out of the US to paint a picture of whether over tightening and a recession is becoming more possible, or if the soft landing is something the Fed is actually going to be able to engineer. Global fixed income are also looking attractive just from an absolute rate standpoint. Global equities, I think we're pretty much in hitting all-time highs for the US. And again, while there may be drivers that can push equity markets higher, balance of risks are looking less and less attractive on the global equity space. On alternative assets, we actually are coming from a more bearish stance and are becoming more constructive on different parts of this space, particularly if it's still tied to that recession soft landing narrative, where if the US actually manages that, then growth fears will price, or an adjustment or a reversal of growth fears will price it in for the rest of the alternative asset spectrum. And maybe gold this time will be the laggard in that space, just a reversal from last year. All right, I think that's my last slide actually. Happy to take on questions, and passing it back to you, Stan.
All right. Thank you, Sandra, for that comprehensive outlook and taking time to lay out the landscape and opportunities for our audience. And at this current juncture, it's our dear audience's turn to ask some burning questions that they might have from this talk this afternoon. So we'll be heading over to the question and answer portion of the event. Actually, checking the chat, we already have several questions lined up. And reminding the audience, you still have time to add more questions as we move along with this portion, and we'll try our best to address them this afternoon. But now let's go through the questions. And for our first question, here in 2024, given rate cuts are coming this second half, is the dividend play still a good strategy? We saw a lot of inflows in that in 2023, Ms. Sandra. So on to you.
I think, why would somebody invest or go into a dividend play? It means there is an income component preference, or there is a need for income. I think fixed income is going to be more suitable for that, because again, it's the objective. If your objective is income, then you'll probably get that and then some in the fixed income space. The problem with dividends is you might get the dividend, but the risk, the balance of risks on the price of the underlying is still vulnerable to the downside. So the total return might just keep you, or it's again better in the fixed income space. Later on, after rates have moved down and there's no more rates in fixed income, or the yield in fixed income has come down, then dividend might become more attractive again, and that kind of demand may push prices of dividend plays higher.
Thank you, Ms. Sandra. And thank you again, audience, for asking these types of questions. And it's the main reason why we have these types of outlooks, to show where these types of opportunities lie. Moving on to the second question. Now moving towards monetary policy, and both locally and globally, And this is a question I think that's on everyone's minds. Will interest rates remain higher for longer?
Yeah, I think so because inflation is still uh, it's still going to be sticky, both on the supply side and even on the demand side, and that is the mandate of central banks to make sure that inflation is well within target. And as long as the threats to inflation remain from both supply and demand side, then they will likely err on the side of caution and keep rates higher.
All right. Thank you, Ms. Sandra. We have another question coming in from the audience. Good afternoon. May we know your forecast for the PSEI level this year in 2024? Thank you.
Well, it's as your guess is as good as mine, but from a fundamental fair value standpoint, as I mentioned in my deck, it's 7,400. It can easily overshoot that. The thing is, from a fair value standpoint, we felt that the index should have closed at 773 for 2023, no? Meaning based on earnings and PE assumption, where we think 12 times is really, really depressed. So we were assuming around 15 to be where PE should settle. That was pointing us to around 7.3 for 2023. Obviously, that didn't happen. So for looking ahead, we've calibrated that. Earnings are still gonna come in at 11%, as you saw earlier. And we're keeping our PE to where it is. So it's really just corporate earnings that are pointing us to that 7.4 fair value. That said, foreign flows can easily cause that to overshoot. You have demand that can come from the retail space also to cause that to overshoot. So, it's maybe 7.4 plus minus 10%.
All right. Thanks, Ms. Sandra. A lot of factors to look out for there as well. And speaking of factors and also the levels, another question from our audience coming in, more on the risk factor side. What are your thoughts on US elections, Ms. Sandra, and how do you expect it to influence market dynamics in the coming months?
Right. Okay. So actually, that's a big thing. U.S. midterm elections. That said, we do find that the incumbent, the Democratic incumbent, is going to be challenged by not heavily challenged by on the Republican side. And generally, markets reward elections where there is no change or where the risk of any policy change is lower. So, and or a deadlocked government, meaning you have a Democrat in the White House and you have a Republican controlled Senate. That is kind of the best case scenario where it will prove to be a non-event in that case. That said, of course, we don't know yet. It's still 8 months to really having a clearer picture of how elections are going to pan out. But maybe the effect of that will be felt 3 months before election. So I guess second half of the year. Medyo matagal pa yon. And there are other elections happening worldwide anyway. Kakatapos lang nung Taiwan elections. That was actually a big that would have been a potentially high risk event, but kind of just happened and flew under people's radars. So yeah, these are, as I said, known unknowns, and it's really difficult to bet directionally one way or another.
All right, so a lot of things to look out for as well. Moving on to another question, and I believe this is asked consistently quarter on quarter regarding AI. Do you see AI playing a pivotal role as a key growth driver in various industries? And if so, how might businesses or even our investors leverage this trend? Thanks, Ms. Sandra.
Yeah, no. So actually, it is a mega theme, I would say, from our standpoint on the investment side, our portfolios, especially our global strategies, have core holdings in our tech fund, which is the instrument we use to have access to those companies that are geared towards this AI-driven growth. And throughout history, any kind of technological advancement is in the big scheme of things where growth is going to come from. If there's no technological change, growth is going to stagnate. And so on one hand, there is the challenge of people losing jobs because of, I guess that's the criticism, diba? Parang as technology advances, there is a risk for AI to replace people's jobs, etc. I don't think so. It's just it's the same as when we invented the flush, I guess, the toilet flush, this is a better analogy. When autopilot came around, the technology of autopilot for planes, we didn't lose the need for pilots, so something like that. It's definitely something that deserves attention and warrants or any investor that will have that exposure to that driver of growth will be rewarded over the longer term. That said, because it's a growth stock that's still sensitive to interest rate outlook. So again, kasi ano yan, di ba? It's a growth stock. So if it's a high growth stock, in the future, it's going to grow, let's say, 10% per annum. Mababa pa nga yun, let's say 30% per annum. So to get to the price today, it needs to be discounted that growth rate. So that growth rate is similar to how bonds work, where if the interest rate moves lower, like the discount rate, then the price today moves higher. So very much correlated growth stocks with bond prices.
All right, thank you, Ms. Sandra. And again, for those interested in adding that into their portfolios, it is available on our ATRAM Global Technology Feeder Fund as well. So moving on to the next few questions. You mentioned in the outlook, we have a dovish BSP outlook in the first quarter of 2024 and the upcoming maturity wall as well in March. How might these factors influence market sentiment, and what strategies can investors adopt to navigate this period?
So I think on balance, it's good to have a balanced approach, both equity and fixed income. But the ability to actively manage is best left with professionals, because professionals are the ones who have a front row seat on all of these drivers of markets that are going on. And as an investor, as an individual investor, it's easy to get whipsawed if you're going to try to time the markets. So I guess timing the markets is best left to the professionals. From an allocation standpoint, you want to have a well-diversified portfolio. You want that allocation decision to match your risk profile, meaning if you have 10, 20-year horizon, it's good to bias equities. But again, because of this part of the cycle where rates are more likely than not going to move lower, you don't need to take on that much risk to generate quite decent returns. So a balanced exposure across the different markets should suffice.
All right, thank you for that. Moving on, we have a few more questions. And considering that the CPI stays below 4%, but on the high side of the inflation range target, how should businesses and investors interpret this scenario? And what implications does it have for market stability?
Okay, the key point is that inflation needs to move within target. As long as it's within target, that makes it less imperative for the BSP or even the Fed to resume on a hiking path. And when that is when the central banks are on hold, the policy flow through to the rest of the market has a chance to play out. Meaning to say, tighter policy is really meant to prevent overheating in the economy. So a bit of a slowdown in growth is going to, you don't want it to slow down too much, such that it tips into recession. So again, even if it's in the higher end of the range, 4% is well within the BSP's target. I guess beyond that, it's inflation expectations that also need to be anchored, because as long as your consumer is expecting inflation to continue to, or to be threatened by their purchasing power is, or they have a perception that their purchasing power is vulnerable, then they're gonna keep from spending. Consumer demand is going to be tepid, and that kind of feeds into, slowing of the economy. That is something that the policymakers need to calibrate carefully.
Oh, perfect. And that's related to one of the next questions coming in from our audience, Ms. Sandra. You talked about the BSP target of 4% inflation and expectations as well. A question coming in is the inflation rate likely to settle around 3% for the remaining months this year? I would like to know your take on this.
Depends on supply side and demand side. Kasi nga, on one hand, from the demand side, we think that it's not a threat. But when you have El Nino and supply becomes tight, then that can influence or that can cause inflation to spike again. And in fact, the central banks have no ability to control supply side inflation. But from a messaging standpoint, they'll at best they'll just keep it on hold and manage supply side risks. No? So for example, if it's El Nino, it's rice prices. So this early we see that there is provisioning for any risk of rice supply coming in short. So we're already importing for those months, etc., etc. And it's a matter of really looking at all the moving parts and having the good news is our BSP is actually one of the better central banks. And the other good news is the Fed is doing an excellent job at really balancing between bringing inflation down and not choking the economic growth engine of the world. So as long as that's the path that we're able to stay on, it's going to be a pretty good year, I think.
All right, perfect. And audience, we're getting a lot of questions in, but unfortunately, we only have time for one question left. Ms. Sandra, is it safe to say that the market this year will be better than last year?
Actually, wasn't a bad year last year. It was a bad year in 2022. Can it be better? It can be better for Philippine equities for sure. And that will only happen if the soft landing scenario prevails. The risks to that are many. So, I'm a bit on the fence. I mean, I don't want to be overly optimistic because, as I said, there are a lot of things that haven't happened yet. And from a risk adjusted return standpoint, I think it's really fixed income the way to go.
Perfect. Okay. Unfortunately, that's all the time we have for questions. But before we end, Ms. Sandra, do you have anything else to add?
What do I have to add? I kind of always like to remind the audience that it's time in the markets that matter versus timing the markets. Timing the markets is our job, and maybe or it's the job of the active manager. And maybe as an example of that, earlier in the presentation, I walked you through our thinking at the beginning of 2023. We got the outlook. We missed the mark on the outlook, as did many active managers. But to adjust and to be able to, so for example, first quarter, you already saw a big rally in US-led equity or tech-led rally. Maybe a lot of investors would have seen that and would have plowed into the markets in March, April. That would have hurt because the markets had went back down to 10% drawdown. 10% drawdown after the first quarter, only to make up the next 18% in the fourth quarter. So on balance, it's just a 3% upside. I mean, it's not bad, but you're better off in fixed income that gave you another 4% if you came in at that point in the year. No? So I think this is the time when active managers have a chance to show their value to clients, because it's really what our job is about. It's really managing all of the risks, responding as the data comes in, and not reacting emotionally to market volatility.
Great. Ms. Sandra, thank you again for those words and another excellent outlook for this quarter. And we want to express our heartfelt thanks for sharing your valuable insights in this webinar. And our sincere gratitude goes out to you, our audience, for your active participation. There were a lot of questions today. Hopefully, we were able to cover some ground. And we genuinely appreciate the time you've dedicated to being with us today. And as we wrap up, we wanted to remind you that did you know that ATRAM Prime offers a diverse array of investment options as well? And these options empower you to tailor your portfolio according to your specific goals and risk tolerance. Committed to long-term growth, ATRAM Prime's expert fund managers utilize proven investment strategies guiding you toward the creation of enduring wealth. For more detailed information, please refer to the video displayed on your screens.
Good day. ATRAM is the leading independent asset and wealth management company in the Philippines. If you are interested in investing in ATRAM Prime, download the app in the Apple App Store or in Google Play Store. You can also visit prime.atram.com.ph to know about ATRAM Prime. If you have other questions, you may fill out the contact form on our website or send an email. We hope this helps. Thank you.
And there you have it. If you want to learn more about ATRAM Prime, please visit the website, prime.atram.com.ph, or download the app today on the App Store and Android Play Store. Now, as promised, thank you again for sending in your questions and for being extremely engaged during this webinar. Here are the winners of our ATRAM merchandise. And reminding everyone that whether you're a beginner to the world of finance and investments or a seasoned investor who just wants to stay up to date with the latest news and strategies, we've got you covered. You can check out our YouTube channel, ATRAM Studio, which features everything you need to know about our past webinars, investments, and finance, and even ATRAM itself. So, like, share, and subscribe on our videos on our YouTube channel, and you can hit the notification bell to receive alerts whenever we upload new videos. And you can access our official social media pages by scanning the QR code found on your screens. And before we end, we'd greatly appreciate it if you could take a moment to fill up our feedback survey. You can do so by filling up the QR code and scanning the QR code displayed on your screen. Your insights on today's topic are invaluable to us and will continue to contribute in enhancing our future webinars. And once again, dear audience, we want to express our sincere thanks for your active participation this afternoon. We extend our best wishes for your continued health and safety for you and your loved ones. This has been your host, Stanley Magno. Good afternoon, and we look forward to welcoming you in our next webinar. Have a wonderful day ahead.